Welcome everyone back to the Price Action Labs YouTube channel. In this video, I'm going to be going over a very specific piece of price action on ES futures, which was the short trade from FOMC. So I'm going to be breaking down the key level, premium and discount, and how this trade actually played out right from key level down to entry and execution. So I'm going to be talking about the short and how Flow State OS, the software that I've coded up at Price Action Labs, helps you to identify this particular setup. Okay, so let's get into it. So the 4 learning objectives of this video are going to be premium versus discount, how to identify the right key level to trade from, order flow for entry, and then knowing where to exit. If you master these 4, trading FOMC or any news event of the sort becomes a lot easier. So we're going to be breaking down this trade in terms of the 4 learning objectives you see on your screen. So let's get into it. So the first is about premium and discount. So most people have understood premium and discount in terms of buying low and selling high. So it's a simple concept, but I want to sort of bring an analogy to help you understand this. So imagine this, right? Imagine you have gold. Imagine you're a gold investor. You're looking at the price of gold to buy or sell. Now, naturally, if you want to invest in anything, be it a house, be it gold, be it crypto, be it anything, even stocks, right? You're going to go to a cheaper shop, or you're going to go to a cheaper broker, whatever it is. You're going to go to a cheaper property real estate investor if you want to get the best price in order to buy a property or buy gold, right? You want to buy something when it's cheap, and then you want to sell something when it's expensive. This is a very basic concept, but in order to map it to the charts, it takes a little bit more skill, and you have to try to train your eye to articulate it in a certain way. So I'll just break it down. So this FOMC trade was based on the principle that we were selling high. All right, so this trade over here, for example, this one over here, the only reason we shorted, or the only reason we significantly melted in price, we went down, is because price was at a significant premium. We were above the 50% area. So this is how I'm going to break it down for you. Think of it like this. This was the market, and this was the FOMC move over here. So look what we have. We have a structural low covered in discount, and we have a structural high up here. And so what this means is that the structural dealing range has been split into 2 halves, right? This 50% area splits the entire dealing range into 2 halves, known as premium and discount. And so the FOMC move, which is roughly here, was in firm premium. We were significantly above the 50% area. And so what that means is this gold bar was priced high relative to the dealing range. And that's the only reason the market went down. So when you're looking to buy something, or when you're looking to invest in something, you want the price to be high when you sell it, right? You want to sell something at a premium. You want to sell something after it's gone up. All right, so imagine gold is priced at, I don't know, $5,000, and gold then goes up to $7,000. You want to sell gold at $7,000 to capitalize on the movement upwards, right? Before you short it or before you sell it. It's the same principle in trading. Once you've identified your structure, you want to know where you are in terms of this dealing range, premium or discount, in order to go long or short. That's what premium and discount represents. So how do we actually transfer this skill of premium and discount to the charts? So your dealing range is the most important thing. So I want you to imagine this. This is a schematic. So imagine you have here a structural low and you have a structural high. This is why it's important to understand market structure. But once you've understood market structure, you have your most recent low, most recent high. And what you're looking to do is understand most recent low, most recent high. And where does that gold bar sit in this dealing range? Are you in premium? Are you in discount? So in this case, this gold bar, or where price was actually above the 50% area, right? If you look back at the chart, we were above the 50%. That's why we had the melt off, because we were in premium. The gold bar was priced high relative to the most recent low and high. So we were in premium. In premium, you want to be shorting. So it's a basic concept, right? So was that gold bar high or was it low, right? It was high. It was in the premium area, so you want to be shorting. That's sort of the first primary concept to understand. That's why the FOMC move was short, because we were in premium relative to the dealing range. All right, so one more time. We were in premium, and that's why the short trade took place like that. That's why it happened. That's fundamentally why it happened. So we're above the 50%. So again, here's another look. This was the FOMC move over here, right? So again, I've gone through this in previous videos. We have structure, targeted liquidity, equilibrium, and price imbalance. This is the equilibrium, which means we're above the 50%. Okay, so that's sort of the first concept over here. Now, the second thing to understand is key levels. And so your key level, I want you to think of it as the market has certain areas that price is magnetized towards, right? Where are the magnets, or how can you find those magnets? Because when you know where those magnets are, you will know when to enter as well as knowing when to exit. So I was talking to a trader recently. He had trouble with exiting trades. He said, I have trouble holding my trades. I have trouble exiting my trades. Well, the reason why is because key levels are often the thing that holds traders back from entering at the right area and also exiting at the right area. And so how I find key levels is by using the magnet theory. And so you want to try and understand the market will gravitate towards previous day highs and previous day lows that have left some kind of price imbalance or inefficiency, right? That's the definition of a magnet. So think of your magnet as having 2 feet like this. One foot represents the previous day high or low, and another foot represents fair value gaps. That is what makes up the magnet, and that's what makes up the force. So you want to imagine when you have these two things, it creates the magnet. And the magnet is where price is drawn towards. So I'll give you an example of this. So this was the price action for that day. This was the FOMC short. And so price was magnetized to this area before it ultimately shorted. Now, of course, you need to use order flow inside of this region to actually know what's going on. It's very difficult to predict the market. You have to simply read what the order flow is doing and then react to it. But in order for you to know where to actually do that, you have to take a step back and understand where is the market being magnetized towards, right? This is magnetized market movement, right? We use key levels to try to help us identify where the market is being magnetized towards. So this is the price imbalance on the 15. This is a 5-minute chart, but this was based off the 15-minute time frame. We had the previous day from Tuesday. So previous day from Tuesday, what the previous day low represents is that this is where sellers were exhausted, right? Imagine we had lots of selling pressure, market. This was the low of Tuesday. So this is going to be a key level mixed in with the price imbalance. It's not a coincidence we shorted from this region, okay? So previous day low plus fair value gap. This is where the market moved, right? This is what we call market magnetized movement, or magnetized market movement. What you want to understand is previous day low, or it could be a previous day high, plus a price imbalance creates these 2 feet, and this is where price will be magnetized towards before it makes its potential move. So just remember, we have magnetized market movements. So right now we've gone through 2 of the learning objectives, which is you want to be selling high at the right key level. So you want to be in premium to short, and you want to be at the right key level. Once you time the market with these 2 things, it becomes a lot easier to take trades, right? Even if your execution is sloppy, even if you don't use order flow, even if you don't know what the news events are going to do, or you don't know what your higher time frame bias is. If you can get these 2 concepts correct, selling high at the right key level, it becomes way easier to go long or go short. And the reason why is because if you look at this chart over here, right, or even if we go back to this chart over here, this chart seems like a lot of noise, right? There's FVGs everywhere, there's trend lines, there's this sweep, that sweep, London high, London low, previous day high, previous day low. How do you know where to actually trade from? That's why I created the magnetized market movement theory, which is taking the 2 basic concepts, previous day high, previous day low, plus price imbalance, to time these moves, because you need to know where the market's being magnetized towards if you want to trade it. Okay, so these are the first sort of 2 concepts. Next is, assuming you've got these 2 concepts right, next is about understanding what's going on inside of the level. And that's where the read process comes in. So I've made lots of videos about this. The read process is about, it stands for recognize, evaluate, assess, and detect, right? That's what the read process stands for. In fact, I'm going to show you on flow state what this looks like. So if you go to the charts right now, here we have flow state. And if I go to, here we go. So this is now the trader's terminal. If we begin the pre-market plan, let's go to the read part. So the way that I've coded up flow state, the way the software works, the way the system works, is it will identify key levels and it will tell you why they are key levels based on real-time market data. So let's take a look at this FOMC level, which was, let's take a look at this one, for example. So here we have, this was the rough sort of FOMC level. So what you can see here, market has calculated what was going on at that level at that time. Okay, so again, analyzing order flow, we're going through the process. So it's telling you there's a bullish price imbalance, or FEG, created on the 16th of June at 6 p.m. Eastern at roughly this price over here. So what you can do, so even as a user, I've got the user interface, right? What you can do is you can see where the key level was formed and why it's a key level. Okay, now this will assist you when it comes to understanding the order flow. So here we have again, analyzing order flow. Hopefully you can see what's going on. Lots of aggressive buying, no reward. So when we go back to the presentation, let's go back to the presentation. When you read the footprint chart, what happens is the order flow or the read method brings the light to the overall execution. So when price enters a key level, you don't know what's going on. So I often say when you first enter the key level, you're entering in the dark. So you want to sort of turn on the light. What brings the light to your trading key level, or what brings the light to your execution? Well, it's the read method. You've got to know what's going on inside of your level. So in order to execute short, right, you want to use a read method to assist you. And this is how it works, right? This is fundamentally why the short trade happened. So here's a spring. I want you to imagine a spring, right? So imagine this, imagine we have price. So imagine a trading view chart. We have price over here and we have time over here. So at this time, looking at the x-axis and looking at the y-axis, this is price, right? This ball over here represents price. This is obviously a ceiling and this is the spring, okay? Everyone watching this video, you will know how a spring actually works. Okay, so let's take a look at this. So imagine over here, this is now this was the candle prior to the sell-off on FOMC. This was the candle. So what do we see inside of this candle? Well, I see one thing. We see blue delta. Okay, yes, I see some red delta, but primarily this is the zone. We see an overwhelmingly amount of blue delta. We see a lot of blue delta. So I don't want you to get too bogged down on the numbers. You don't necessarily need that for this demonstration. But what you want to understand from the read method is, what does blue delta mean? Okay, let's break it down. What does blue delta mean? So from the flow state perspective, let's go back. So I've also coded up flow state so that it can help you with your actual trading, right? So if I go to the read method and like this, let's see what we have. So here we go. So continue. There we go. So recognize, evaluate, assess, and detect. This is the read method. So when we look at the read method, let's say we want to assess. Let's go to assess. Okay, so we have aggressive buyers, aggressive sellers. So what does the blue represent over here? So when we have blue delta, it means there are more aggressive buyers, right? So it means that buyers are sort of, they're more aggressive than sellers. There are more market participants trying to drive price up than drive price down. Okay, that's what was happening at FOMC in this sort of price action here, right here, right? That's what was going on. So this candle is what I'm trying to demonstrate in the presentation over here. Okay, this is what I'm trying to show. So imagine again, you have a spring and you've got the candle. So what's going on is all this buying activity, this aggressive buying activity, is pushing price up, but it's up against a spring. Okay, look at that. There we go. So just try and imagine this. Try and buy into this with me, right? We see the blue delta, which represents aggressive buy orders. They're hitting the ask, right, more than the bid. That's what causes the spring to compress, right? This is a spring compression. So without going into a physics lesson, when you compress a spring, there's energy, there's a force that's being applied upwards. That represents the blue delta. There's actually an equal and opposing force. There's energy that's being stored up in the spring, right? So imagine this, right? Buy energy equals sell energy. What eventually drives price down is passive sellers. So all the energy that's being used to drive price up is being stored in this spring. And so why did price move down? It's simply because the spring was absorbing all the aggressive buyers, and that's why price moved down. So when the spring compresses back to its original length, this is the equivalent of the passive sellers stepping in. They're absorbing the aggressive buyers, and that's why price moves down. This is the analogy I want you to buy into. So it's not a difficult analogy when you wrap your head around it. It's just about understanding. Buyers will enter the zone and push the price up, or they'll try to push price up. They won't be able to because they're being absorbed, right? Just the same way that when you compress a spring, the spring is absorbing that energy, right? In the markets, who's absorbing the aggressive buyers? It's actually the passive sellers, right? That's what creates supply, that's what creates resistance. And that's the reason the market moved down the way it did, right? This is the only reason the market moved down. There's no other reason for it. Okay? So if we just go to the charts now and sum this up, just from a candlestick perspective, what we can see again is FOMC was here. Okay, this was FOMC. So what we had over here is we had previous day low here, key level. Price obviously tapped into the zone here. Okay, so if we go now to a 1 minute time frame, what we will see is this, right? We will see this. This was the FOMC movement here. Okay, so FOMC, this was probably 2:45 Eastern. Yeah, 2:45 Eastern. And so what we had was a huge break, which showed seller strength. Then we tapped into the zone over here. So what was going on inside the zone? It's exactly what was going on here, right? All this aggressive buying, all this blue delta over here. That was what we saw. Is we saw all the buyers unable to break above the zone, and that's why we had lower prices, right? Because of the spring. So imagine this key level here being like a spring. So imagine the spring is like this. You coil the spring so it looks like this. All that energy is passive sellers that drive price down. And the spring represents the key level. In this case, the market's key levels represents the spring. Okay? And that's sort of that's basically how FOMC happens. So I'm going to quickly go over this one more time so that we can quickly go over. So the FOMC move happened because of a key level and buyers were absorbed and by passive sellers. And that's why the market moved down. So we went through premium and discount, key level identification, order flow for entry, and then using levels to enter and exit. Okay? So if we now go ahead, so premium and discount, the only reason the market fundamentally shorted was, yes, sellers were in control, but we were selling at a premium price, where we were expensive relative to the structural dealing range. So when you have your most recent high and low, you want to get crystal clear on the market structure. You then want to get even more clear on where that gold is sitting, right? Where is price sitting relative to the most recent high and low? This is the equilibrium. This is the 50 percentile, okay? So again, gold, is it high? Is it low? So price, the gold bar was pretty high before market tanked, right? This is the analogy you should buy into. The gold price was pretty high before the FOMC move came and tanked it down. All right, you want to be shorting at areas of higher prices. Okay, again, we're above the 50%. We're here. Now, next we went over key levels. So you want to understand previous day highs and previous day lows with a price imbalance are magnetized areas, right? The market will gravitate towards these areas. Previous day highs and previous day lows are what make up the 2 feet. So just imagine this was the move, right? This is sort of a 5-minute chart where we've zoomed out and we've looked at what's gone on. This here says a lot. So we're in premium. We've tapped into this previous day low and price imbalance area. The market was magnetized towards this area on multiple occasions, 1, 2, and then 3 before the short happened. Why was the market magnetized towards this movement? This is what I call magnetized market movement, right? It was magnetized there because of 2 reasons, a price imbalance and a previous day low. When you combine both of them, how I like to see is this is the 2 feet of the magnet, and this is what creates the lower prices. Okay, so we want to be selling in premium at a prime key level with the 2 things I've just gone through, and that's what makes a good short, right? And vice versa for a long, you want to be in discount, you want to be sort of at another previous day high or low price imbalance to go long, right? Same thing, just flip on its head for a long trade. Then we went over order flow, and this is where I want to say those who trade without order flow will end up paying those who do. On a long enough time horizon, if you're not reading the order flow or understanding how it works, then you're trading quite literally blind because you have no way of guessing or predicting ever. You don't have any way of doing it. So in order to execute short, you want to sort of bring the light to your execution. You want to turn on the light inside of your key level. You want to know what's going on. And then we use the read method to do that. Okay, so for those who don't understand the read method, I've been through it a few times on flow state. I'll go through it again, right? This is how the read method works. So again, recognize, evaluate, assess, and detect. Now, each of these, once turned on, will make a very bright and clear sign to your trading. And again, this is what the acronym stands for. So you want to recognize the bid and ask, evaluate the delta, assess the aggression, and then detect the zeros. Okay. And then when you do that, that is how you get that's essentially how you trade with clarity. That's how you trade with execution. And the final thing I want to leave you on is understanding how key levels actually form. Because key levels themselves do not form because of lines you draw or angled lines you draw or indicators or boxes or anything else. You can draw those things, but unless you understand the mechanics behind why the market moves up and why the market moves down, it becomes very difficult to justify any position you take. So here's a spring. Look at the spring carefully and ask yourself, if you were to compress the spring upwards, what would happen? Now, when you compress the spring upwards, the spring itself will store energy. For those who have kind of imagine right now you're literally compressing a spring upwards. So imagine you have a ball. The ball represents price in this situation. When you compress a spring, right, it's very difficult to keep compressing it. Eventually, when you let go, the ball will just bounce lower. This is exactly what's going on inside of a key level, right? Aggressive buyers are pushing the spring, right? They're applying an upwards force or an upwards, the energy is pushing upwards, basically. Now, with that upwards energy or upwards movement, again, from these aggressive buyers, the spring is storing energy, but we're not breaking above the spring. We're not breaking above the level. The energy that's absorbed here is very much equivalent to passive buyers or absorption of these aggressive buyers. Sorry, passive sellers. Passive sellers absorb the aggressive buyers, and that's what drives price down, right? So price is the ball in this case, and that is the only reason the market moves down. That's the only reason the market moves down. Okay, so I wanted to sort of go through this FOMC trade with people so they understand how to look at markets, how to find levels, how to kind of theorize the levels in terms of supply and demand, bid and ask, and I hope that was useful.